Hi, everybody. I want to extend a warm welcome to those of you who are already on the call. We're going to expect a number of attendees to come still. So while we're giving it time for them to gather, in the meantime, I'm going to cover some housekeeping items to get us started. To start with, you'll notice that your lines have been muted and your cameras are turned off. On your screen, you will also notice you can submit questions via the control panel. We'll try to cover as many as we can at the Q&A session at the end of the presentation. We'll have a chat feature. You can see the chat feature there. And from there, what we're going to do is provide some links where you can sign up for our other research that we do. We've got daily commentary. You can also sign up to automatically receive the global monthly outlook. And like I said, we'll post that in the chat feature there. So today I am joined by George. George is the FX and macro strategist for the UK. I'm Joe. I'm the analyst for the US based near Washington, D.C. And George and I are happy to have Sven with us. He's our European corporate hedging manager, and he's going to provide some key insights and considerations to help companies like yours manage FX risk. So what we're going to do today, we're going to cover a global economic outlook. George is going to handle that. From there, we'll have a bit of a tag team approach where I'll cover the North America currency outlook. I'll toss it back to George, and George will provide the UK currency outlook. From there, we'll give it to Sven. He's going to handle the risk management insights. And after that, we'll have a Q&A session that we hope you participate in. So before I toss it to George, I did want to take some time to really talk about some of the key insights to really cut through some of the noise that we're seeing in terms of markets and really highlight the important themes that are dominating the macro space and really influencing financial markets. I'll give it to George in just a minute, but like I said, some of those key things you can see is that in the US, the dollar has really bounced back from the 15-month lows we saw in July. At one point in July, the dollar index, the trade-weighted dollar index, broke below 100. And that was meaningful because that was the first time the dollar index had broken below 100 since April of last year, April of 2022. In the UK, or excuse me, in Europe, we've seen both the euro and sterling fall to June lows against the greenback. And that's pretty much on worries about global growth. And what that did was spark some safe haven buying of the US dollar. And the dollar has also been boosted by signs of a resilient US economy. And what that is doing is setting treasury yields higher. We've seen the yield on the 10-year top 4.3%. And that's a meaningful move because that's the highest level since the global financial crisis. You have to go back to 2007. And that's a level where we pretty much remain today. Down under, we saw that the Aussie dollar has fallen to 9-month lows below 64 cents. And we've seen that the Chinese weakness, that threatens to curb Asian demand for some of Australia's key exports. And of course, weakness in China, that does pose a headwind on global growth. So as a result, that has taken a toll on some of the commodity-backed currencies like the Aussie. So over just a short space of time, we've really witnessed some meaningful shifts in the FX landscape. And that really highlights the importance for companies with exposure to FX markets to keep in mind when making planning decisions. For this calendar here, really the road ahead for global monetary policy is going to really depend on the strength of data. With that in mind, here's our risk events calendar for September. And it really highlights some of the big data events that are yet to come. Some you may want to circle on your calendar. We'll also put in the chat function where you can find a link to get this month's report, the Global FX Outlook Report. And that's where you can find the calendar as well as all of the research that we'll be covering today. But some of the key events that warrant close monitoring: inflation. Inflation certainly holds the key to the outlook for central bank policy. That's going to be a key thing to look out for. We'll have inflation numbers as well as jobs data. The jobs data from the US, we typically get that on the first Friday of every month. And we've already seen that. And that showed another month of solid hiring for the month of August. So again, that's played into the bounce back that we have seen in the US dollar. And of course, central bank decisions. And the central bank decisions this month, being the month of September, they tend to carry more weight and market influence because central banks like the Fed and the ECB, they publish new economic forecasts. And in the case of the Fed, the US Central Bank, it also publishes projections of where it sees interest rates headed over the coming year. So really important stuff. So now I'm going to toss it to George. George is going to unpack some of the important macro themes to be aware of, covering key topics like interest rates, inflation, and the tightening of credit conditions, how they are influencing currencies.
Thanks a lot, Joe, for the introduction, and of course a warm welcome from my side to everyone listening to the webinar. As Joe mentioned, my job today is to explain some of the macroeconomic developments that have shaped financial markets in recent months, and also to try and give a bit of forward guidance around what could happen this month and beyond, and in terms of the key data points and themes that we're looking out for. So Joe already laid out the key events that we're going to keep our attention on. So my part is centered around bringing these individual data points together into broader themes and narratives to better understand markets. So the first theme is related to what we've been discussing throughout our webinar series, and that's inflation, the monetary policy response that we've seen, and the market implications. And essentially, we're still seeing a lot of elevated volatility in bond markets, which is impacting currency markets as well. And why are we seeing this? Is because of those each economic data points that remain highly important, are impacting the interest rate outlook globally, and that's having an impact on bonds and currencies because they're sensitive to that. So the debate that has sort of shifted from gauging where inflation is going to peak to how fast it's going to fall to that 2% target, especially because of the demand-driven stickiness of services and core inflation. That's made it difficult. And as a result, we've seen a shift in market sentiment visible on the yield curve. As you can see on this chart here, it shows the average performance of the 10-year and 2-year yields of G10 countries. Now, we've seen, particularly last month, that investors are pushing up bond yields on those on the long end. This kind of is reflecting this notion that interest rates are going to have to remain higher for longer. As Joe said, the 10-year US Treasury yield, for example, hit its highest since 2007, and that's been helped by the resilience of the US economy, in particular, in the face of rate hikes. We've had robust consumer spending, and still we've got that relatively tight labour market conditions as well. But we are seeing some cracks starting to appear on the global macroeconomic outlook, and that's limited the upside on the global move up in yields on the basis that central banks will be forced to cut interest rates at some point next year. But it is also true that a soft landing scenario for the US is gaining more attention, i.e. that the US economy will avoid a recession, but we think there's still a high risk of that happening. It's just been a delay instead until some point early next year. If we move on to the next theme, so we're assessing not just the impact of those higher rates on economic growth, but on trade as well. So yes, we've witnessed US exceptionalism so far this year, confounding those expectations of recession, but the same can't be said for Europe, especially Germany, and also we've had the lackluster recovery from China, of course, and hence global investors are caught between this tug of war between strong economic growth in the US and rising yields in the US, and a weakening economy and low interest rates in China. And Europe's sort of been in the middle of both these worlds, but has started to lean more towards the east, just because of the impact of the lackluster Chinese recovery and the broader impact that that's having. And the loss of momentum is most visible in trade. So though pro-cyclical indicators like exports, industrial production, and container throughput, they're all on the decline. And this chart here illustrating the slump in exports, the export volume that we've seen since its last peak. I mean, Europe's been at the epicenter of trade for the last couple of decades. So it's really feeling this trade slump, especially Germany, as it's one of the highest has one of the highest trade dependencies of the developed world. So as global demand for goods continues to falter against this backdrop of higher prices and higher interest rates and changing consumer preferences as well, it's those pro-cyclical countries that tend to face the most severe negative consequences. But the big question for us is how long this takes for this slowdown in industry and industrial disinflation process to actually feed through to the consumer inflation as well. So it's something that's being made harder, of course, by the tight labour markets and particularly strong wage growth as well. And that's something that's of particular concern in the UK for the Bank of England, for example, and the UK's inflation outlook with the second round effects of inflation and the lagged impact of monetary policy. Which brings us on to the third theme and linked to the impact of higher interest rates, and that's credit conditions. Because basically, although we are nearing the end of course, one of the most aggressive tightening cycles ever, the impact of those higher rates has yet to be completely felt. And although we don't expect credit conditions to tighten much further, companies and households are going to have to get used to or adjust to this new high rate environment. So tighter lending conditions, tighter lending standards from banks as a result of these rising interest rates are going to crimp down on credit flowing to households and businesses. And one source of information that's becoming key to watch for us is the Senior Loan Officer Opinion Survey from the US. It shows US banks' tighter lending standards have actually breached the threshold that in the past was consistent with a recession. And in addition, the share of small US firms reporting it's difficult to access loans rose to a 10-year high recently. And it's a similar story in other advanced economies as well. But this particular chart here shows the yearly change in the net percentage of US banks tightening credit conditions, having jumped to the highest since the financial crisis, as you can see. But it also shows the relationship between bank lending conditions and the unemployment rate, with higher borrowing costs and less credit available. This is increasingly going to weigh on economic activity, and we fear that it's going to that the employment rate is going to climb higher as a result of this. And therefore, we do believe that US interest rates have peaked and the next move is more likely to be a cut. But the timing of that is still uncertain. We do believe it's going to be in the first half of next year, though. Moving on to the next slide, the event in focus for this month. Joe pointed out earlier, we've got a whole host of central bank policy decisions, and these are important. And currency markets are currently pricing in the Fed to keep interest rates unchanged this month, whilst markets are actually pricing a 70% chance that the ECB will hold as well, whereas the Bank of England is most likely to hike by another 25 basis points. But what this chart here shows is a development of the market implied policy rate expectations over the next couple of years, comparing the ECB and the Fed. And the reason we're showing this one is to just highlight how at the beginning of this year, this ECB was expected to out-hike the Fed considerably, or rather the Fed was actually expected to start cutting interest rates a lot sooner than the ECB. But since we've seen a continued deterioration in European economic activity relative to the US resilience, as we know, as we've seen, these rate expectations have converged completely, as you can see, converging to that dotted line of zero there, i.e. this signals the ECB is no longer expected to out-hike the Fed. And as a result of this move, we have seen a sharp depreciation of the euro, losing about 5% of its value against the dollar since reaching the multi-month high in July. So given the most uncertain central bank decision appears to be the ECB's this month, sort of a toss-up between whether they will hike or not, and because of the vulnerability of the euro that we've seen of late, we think that this ECB meeting is going to be the main event in focus. It could be the ECB's last chance to hike and support the euro from sliding further in the short term. And then my final slide in this section provides a nice segue into the FX section coming up. It's one that relates to both the pound and the euro against the dollar, and it ties into some of the previous comments I made on the other slides. Ultimately, it's not just about interest rate differentials that's driving currency volatility, but it's about the broader economic growth outlook as well. If we look beyond that short-term cyclicality and take a look from a wider lens, we see that the relative growth differentials are also highly important, and they correlate with relative stock performance as shown on this chart here, but it also holds true for currencies as well. So since the global financial crisis, as I pointed out on the dotted line there, the US economy has performed far better than the Eurozone and the UK. And as you can see, we've seen demand for US assets increase accordingly with the stock market and the currency, the US currency outperforming over this time as well. And as we've illustrated several times, the unexpected US exceptionalism of this year has attracted investors into the US dollar, defying those expectations of a long-term downtrend unfolding. It isn't to say that that isn't going to happen, and it's just a matter of time before it does, but really to turn structurally bullish, i.e., more positive and expecting the pound and euro to significantly recover against the dollar, we'll have to see economic growth pick up significantly in the Eurozone and the UK relative to the US as well. But we don't expect this strong recovery in either of these economies. So the upside potential for these currencies may be limited. And as I mentioned at the start, the weak Chinese recovery hasn't really fared well for the European economies either. And in fact, when we studied the euro dollar and sterling dollar historical trends, we found that all 4 periods of strength and multi-year highs after the global financial crisis only occurred during times of expansion in the Chinese manufacturing sector. So China as well remains an important influence on the economic and trade outlook, but also on the currency outlook as well. So with this in mind, I'll hand back to Joe, who'll dedicate some time to explain how currencies have been trending amid these latest developments.
Yeah, thanks a lot, George. Thanks for really unpacking the global landscape and making sense of that. So my job here is to talk about the picture here in North America. And here I want to highlight 2 currency pairs, US Mexico dollar peso, as well as dollar Canada. I want to talk about the peso here. It's the second one from the top. And this pair, this really illustrates what's already been a volatile year for the US dollar versus Mexico. You can see that the range so far this year has been more, more than 17%. And we're not even through the third quarter. And that 17%, what that is, that's the difference between the high for the year. The high watermark came at 19.5, 19.5, compared to the recent low, 16.6 roughly, for the year-to-date low for the peso, for the US dollar versus the peso. And that actually marked an 8-year trough. So the dollar, as you can see, it's off its lows. But certainly the dollar remains in the lower camp, the lower half of the range against the peso. And much of that has to do with monetary policy. U.S. interest rates, roughly 5.4%. That's the highest level in 2 decades. But if you look south of the border in Mexico, interest rates are at a record high, double the U.S., 11.25%. And so those interest rate differentials, that has really been key. And that is what's driving the peso outperformance against the dollar. Now, in terms of Canada, you can see U.S. CAD, that's down towards the middle of the pack. So far this year, we've had some kind of more garden variety volatility with the dollar versus Canada trading within a 6% range. If you compare the high for the year, that was above 138, and the low just below 131. And some of the more limited volatility we've seen for dollar Canada has to do with central bank policy, much like between the Fed and the Bank of Mexico, between the Fed and the Bank of Canada. Both of those central banks have been on a similar policy path, if you will. Interest rates in Canada are at 5%. The Bank of Canada this week, yesterday, they held their key rate at 5%. It was more of a hawkish hold where the central bank acknowledged that the economy has entered a weaker period of growth. But at the same time, policymakers aren't really confident that inflation will return to their 2% goal anytime soon. And so what that did was keep the door cracked for Ottawa to potentially raise interest rates from this 5% level, which is also the highest level in 2 years. So again, seeing some more garden variety of volatility when it comes to dollar Canada. And one of the things that's caused the dollar to go from a hole to climb out of a hole for the year versus Canada has been worries about China, worries about the Chinese economy slowing to the point that it damages global growth. That's weighing on a lot of commodity-backed currencies, and that's why the dollar has popped above 136. That is the highest level we have seen now in 5 months, the US dollar versus Canada. Now here, I do want to talk about some volatility, the value indicator rather, and this is how we size up a currency's performance against its long-term averages. And what that can do is highlight some favorable moves or even some unfavorable moves. And here, I certainly want to talk about the Japanese currency. The Japanese yen is certainly getting a lot of front page news, given that we've seen it fall to lows for the year against the greenback. And it's not far from the key 150 level. When we topped 150 last year, as a matter of fact, a year ago, we saw that Japanese authorities stepped into the market to buy yen to try and put a floor under the currency and sell the greenback. And that's not an operation that Japan does frequently. The last time we saw some intervention from Japan was back in the late 90s, 24 years ago. So that just goes to illustrate that Japanese authorities really don't take this action frequently. But given that we're in the similar neighborhood to where we were last year for dollar yen, that has the market a bit on edge. But here you can see that compared to the year-to-date average, the dollar even at 145, we've since appreciated from that level. But even at the 145 level, that shows that the greenback is 6% stronger than its average rate for the year, that being right around 136 to 137. And really, if you take a higher level view, if you look at a year, the dollar is 5% stronger now compared to where it was a year ago. The average rate, 138. If you go out 2 years, we're nearly 12% stronger for the greenback versus Japan, given that the average rate over the 2-year time frame has been 130. And look at the view from a 5-year window. The dollar is up 24% compared to the average rate over the last 5 years at 117. So again, this just goes to show how we've seen some explosive volatility. It may not be overall for the US dollar, but we're seeing some key policy divergence, and that has really taken a toll on the Japanese currency, mainly because Japan's really been hesitant about joining other central banks in tightening monetary policy. Japan long fought a bout of deflation or falling prices that can really weigh on the economy. So Japan has been really cautious about moving off the zero bound level. But when that day comes, that could be something that could certainly propel the Japanese currency higher. I was going to talk a little bit about the pound, but certainly George is going to cover that in his section. But again, the pound has been one of the high-flying currencies this year. The pound this year, it's about nearly 2% stronger than its year-to-date average, and that being around 124. And over the past year, the pound has really bounced back from those all-time lows we saw a year ago. That was inside of 104. So the pound has bounced back some 4% from its average 1-year rate, and that being about 121. So next, I want to talk about some currency forecasts, some future scenarios. Already, we're seeing the euro. You can see here on this chart on the left side, that offers a more of a historical perspective going back to the middle of 2022. You can see how the euro bounced back from those 20-year lows back in September. And right now, at the last check before we got on the call, I did notice that the euro had fallen below the key 107 level. And that's really important because that's where the euro ended last year. So that has served as a key support. So that could be a sign that if the euro makes a meaningful break below 107, that could suggest that we could see more weakness, at least over the short run. But nevertheless, the central scenario does call for the euro to bounce back, maybe not in the days and weeks ahead, but maybe towards year end, we could see the euro drift a little bit higher. And that's on the view that if the Fed moves to the sidelines, or if the Fed is already on the sidelines and the ECB continues to raise rates, perhaps that could provide some support for the euro. Now, the other currency I want to highlight is dollar Canada. And like I said, it's been a pretty choppy year. Not long ago, the dollar had fallen to 10-month lows against its Canadian counterparts. That was a level we touched a 130.90 for dollar Canada not too long ago. That's the low watermark for the year. But again, the U.S. economy has shown growing signs of resilience, and that's putting upward pressure on Treasury yields. And that picture of resilience really stands in contrast to what we're seeing globally. A lot of concerns about global growth going the wrong direction. And so that has prompted some safe haven buying of the US dollar. So over the course of the year, again, it looks like the upside pressure remains on the dollar versus Canada, but perhaps closer to year end, maybe deep into the fourth quarter, perhaps we could see the Canadian dollar claw back some ground. And what's going to be key to that scenario is whether or not we see a meaningful or a steady decline in Canadian inflation. That holds the main key to Bank of Canada policy. And if it looks like inflation is just taking a sluggish and gradual descent back to the central bank's 2% goal, well, then again, the market might have to reintroduce the risk that Ottawa might have to hike interest rates, and that is seen as a factor that could support the Canadian dollar should the Fed, again, stick to the sidelines. So from here, I want to give it back to George, and George is going to provide the perspective from the UK. All yours, George.
Cheers, Joe. So firstly, let's have a look at some of the recent volatility witnessed in sterling denominated currency pairs. So the heat map table on the left provides the 30-day and year-to-date highs and lows and the size of the trading range during these timeframes and the position of the currency pairs within these ranges on the right-hand side. And as you can see at the bottom of the table, sterling has been pretty flat against both the euro and the Swiss franc over the past 30 days and actually a year to date, really. But scanning over to the bottom right of the table, you can see sterling euro is near the top 20% of its year to date range. And at the top of the table, you can see we've had some more volatility in the pound against the likes of the South African rand, Norwegian krone and the Aussie and Kiwi dollars due to the volatile commodity prices we've seen and the mixed Chinese economic data, with these currencies tending to be more sensitive to the global economic outlook and also commodity prices. In the middle, again, calling out the Japanese yen, as Joe did, because like most currencies, the pound is still near multi-year highs against the yen due to those widening yield differentials because of the Bank of Japan keeping interest rates so low, inviting investors to sell the yen in favor of higher yielding currencies like the pound. A 20% range in sterling yen so far this year, massive, and the top currently it remains in the top 5% of that range right now. So very attractive levels if you're a company needing to purchase the Japanese yen. And against the US dollar, the pound did have a weak month last month after swinging a narrower kind of range of 2.4%. It ended August over 1% lower, still backpedaling further from that 131 level that it reached in July, which was a 16-month high. And when we look at the year-to-date stats, the currency pair has swung over 11%. And is still up in the top end of that range. And as you can see on the bottom right chart there, it's over 4% gain, the pound against the dollar there, crushes the median performance of a 2.5% decline that's been on an annual basis since 2014. And in fact, this year has been the pound's 9th best start to a year against the dollar since 1972. So a key stat there. One of the main reasons for this sterling strength, as we know, is that the surge in UK interest rate expectations at one point to beyond 6% this year. And this was due to UK inflation proving more stubborn, particularly services inflation being driven by strong wage growth, but also the resilience of the UK economy, defying expectations of a long drawn out recession as it was expected by a lot of economists at the start of the year. So with the rate expectations rising, UK gilt yields have marched higher as well. They sent the UK US yield differential to its highest since 2014. But as I mentioned in the macro section earlier, for the pound to maintain its advantage in this high interest rate environment, UK economic growth must remain resilient as well. We're going to have to see that resilience continue through to next year, and it's not looking likely. So alternatively, this a high interest rate but low growth environment is probably going to be unsupportive of the pound's valuation. It's something to be wary of going into year end and into next year, and we're already seeing signs of this kind of apprehension given sterling's 4.5% depreciation from those highs seen a couple of months ago. Moving on to the next slide, the value indicator slide as well. Because of this delay to the UK recession that we've seen so far this year, and the yield appeal that I mentioned, the pound, as Joe mentioned, has been one of the top performers this year in the currency space. It's actually stronger than 80% of 57 currencies globally, and is on average over 9% stronger versus these currencies, which is really good news, of course, for UK importers needing to sell pounds and buy foreign currency, but not so good news for UK exporters selling a foreign currency and buying pounds. On this particular slide, we're looking at our value indicator analysis, where we can see where sterling is currently positioned relative to long-term averages against other currencies. As Joe mentioned, this allows us to identify from a broader lens any sort of purchasing opportunities, but also any risks as well. So, for example, if you look at sterling versus the Japanese yen, again, it's 10% above its 1-year average and nearly a whopping 24% above its 5-year average. So again, highlighting the attractiveness of buying yen for a business at the moment. And if we look at sterling euro, for example, you can see it's further down the table, but it's still over 1% above its year-to-date, its 1-year and its 5-year average rates. And yes, we don't see much volatility compared to other currency pairs, so relatively speaking, but due to the growth and the interest rate differentials favouring the pound right now, the current position does make sense, but it could also be seen as a decent opportunity for hedging future euro purchases when we compare this value to long-term averages. And against the dollar, the pound is still over 4% above its 1-year average rate, as Joe mentioned, at 120, 170. We briefly saw the pound jump above 131, as I mentioned on the previous slide, and that's a level which we've been below for 60% of the post-Brexit period. And when we entered that 130 to 130 kind of territory, we actually entered overbought territory, overbought conditions when we got there in July. And then we saw a sharp pullback from those highs, as the chart on the bottom right depicts there. But we've also seen a bit of a rebound from a so-called oversold territory late last month, but the downtrend still appears intact for the time being. Sterling dollar is trading below its longer-term 5-year average rate of 128.60 right now. So it could be seen for any companies out there needing to sell dollars and buy pounds, that this could be an attractive or a decent opportunity to hedge at current levels. But of course, we do appreciate organizations will view certain exchange rates and hedging opportunities differently, which is why we provide as much data-driven insight like this as possible to support those more strategic conversations that you have with your account manager and corporate hedging managers. Which moves me on to the next slide, our forecast scenario slide. And again, just to reiterate the stance at Convera here, that we believe taking this scenario-based approach is more suitable, as opposed to trying to outright predict where the market is going to go, just purely based on the inherent inaccuracy of forecasters trying to do that. So instead, evaluating these various scenarios that may occur in the future and understanding the possible exchange rate outcomes that come with these scenarios should help us identify those high-risk situations to try to avoid or minimize the potential losses, but also to identify any opportunities out there to prepare to act upon as well. So as Joe mentioned, what this chart actually shows, the left-hand side showing the historical exchange rate of sterling dollar, and the right showing the different paths the exchange rate could take. And in partnership, this is with Oxford Economics, the base case scenario and a high and a low scenario are generated via an economic model using hundreds of variables, some of which include interest rate growth and inflation differentials. And from that baseline scenario, we calculate one standard deviation above and below to provide a more central scenario, which is the grey shaded area in the middle there. And that's going to cover about 68.2% of the outcomes. So in layman's terms, there's a near 70% probability the exchange rate is going to fall within that range. And as you can see, the top end of that range by the end of this year is 130, and the bottom is 124. And this is, of course, going to be heavily dependent on the incoming economic data and the policy decisions that we have. If the UK economy does continue to defy expectations of recession, supported by the excess savings that households could draw down on from the pandemic, and the acceleration that we're seeing in nominal wage growth, keeping consumer demand strong, then inflation is likely to take longer to come down in the UK. Yes, but this does also put pressure on the Bank of England, keeping interest rates high, perhaps even raising even higher, and that's constructive for sterling, as we've seen this year, especially if the economy doesn't fall into recession. This is a big if, though, especially considering the increasingly negative impact that these higher rates are having on the economy. And we are seeing a slowdown already, as I've mentioned. And as we discussed before, the big downside risk for the pound is that stagflation happens, i.e. high inflation. So inflation persists, but the economy continues to weaken. And it does seem like an ever-increasing scenario. And the other reason that we could see more of a downturn is the lagged impact of monetary policy that could drag the economy into recession. And that could be via the downturn in the housing market, i.e. the delay to mortgage holders having to refinance at higher rates. There's a huge percentage now that where mortgages will come to an end next year and in 2025, and that's going to be really felt in the real economy as well. Hence, the risk of a UK recession is still alive for sure. It just seems that it's taking longer to materialise. That's due to the drawn out transmission of the monetary tightening that we're seeing. But the upside scenario of the high 130s as well is also plausible. You know, we have seen we have seen the economy remain resilient this year, particularly in the services sector. And if we do see a sharp cyclical uptick in the UK manufacturing sector, that limits the recent downturn that we've seen in services, that could be a reason. But it does seem unlikely, given that interest rates are going to remain so high for so long. And it's also going to be dependent on China's growth outlook to improve as well, as I mentioned in my macro section earlier. But the key takeaway, as ever, is that no one really knows what the future holds. You know, opposing forces are often in motion, and it depends what global investors deem more important at a particular time, and that's what's driving short-term volatility in the currency space, at least. And this can change on a daily basis depending on the economic data that comes out, but also from central bank speech as well. You know, the narrative can be turned on its head in a flash. So it's really imperative to consider these range of scenarios. Make sure that as a business, you're sufficiently positioned to take advantage of any favorable moves in the exchange rate, but also sufficiently positioned to be protected from any adverse currency moves unfolding as well. And one final note from me before I pass back to Joe is that our monthly report that has our FX forecast scenarios has a sterling euro on there as well, but we also produce many more. So do reach out to your account manager if you require any further forecast scenarios for different currency pairs. But that's it from me. Back over to you, Joe.
Great. Thank you so much, George. And now this is the part of the conversation where we're going to bring Sven, and he's going to help us. We're going to pose some important questions to him for his take and insight. And this has to do with risk management insights. So what do these big moves in FX mean for businesses, say, as it relates to budgeted rates and profitability?
Yeah, thanks, Joe. And also thanks, George, for your valuable insights and the outlook on the currency. So, well, surprisingly, moves in currency often mean direct moves in your cash flow and profitability. So we have seen that some major currencies have moved like 20% or even beyond 20%. So let's imagine that you're importing goods from Asia, you pay them US dollar, but then the currency increases by 20%. And maybe if your profit is not as big, it could mean you run a risk that your business is not profitable anymore. So depending on the underlying margin in your respective business, you have to calculate until which level your business is still profitable or not. Currency management in general plays an important role for most of the treasury departments we speak to. It is often mentioned to be the #1 concern in the financial department because of the volatility and also because of the, let's say, the comparison between you and your competitors. Maybe they sit in different countries and have different foreign exchange situations. Currently, the main focus is on the interest rate differentials, as we heard earlier, and we see a hawkish environment of central banks. But we are pretty sure one day this can and this will change, and then we go the other way around. However, at the moment, we don't know which central bank will change its policy first, or which central bank will then decrease interest rate, how aggressive. So this is quite uncertain. So the future is not quite easy for corporate treasurers. And if you look back at the wider scenario of euro-dollar, we shouldn't forget when euro-dollar started trading in 1999, we have seen the currency between 0.85 and 160 against euro. So euro-dollar is one of the biggest, or is the biggest currency pair in the world, and you can see how big the impact can be and how big the swings can be in the biggest currency pair. So think about smaller currencies can be even tighter, even tougher. At the moment, we are at the 1 of 7 levels, as we heard before. So there's a lot of room in both directions, and don't be too sure that the current level will stay forever. So what we hear when we speak to clients is often that in low volatility scenarios, as we have it quite now, so the rate has been the same for quite a while, hedging is being neglected. But we can only say heads up, the change in volatility is never announced in advance. So it just happens when you're not prepared. So one day we see a major political event or major central bank event, and then the volatility is there and maybe you have not been prepared. So especially, dollar importers such as travel companies in Europe or importers of dollar-denominated goods, they suffered already when the euro was below parity because dollar was just too expensive for the underlying business. We offer enhanced strategies to leverage the import rate, especially for those who missed to trade when the rate was there and are now having maybe budget rates that are higher than the current euro-dollar level. I mean, there's also opportunity in the market. If we look at China, the Chinese renminbi, especially against the US dollar, is pretty weak at the moment. We've seen the rate being above 7 for quite a while, and maybe this opens the opportunity to speak to your suppliers when you pay them, maybe not to pay them in US dollar, but maybe switch the invoicing to renminbi currency and then trade the currency directly. That can be a favor for corporate treasurers. And last but not least, it is a bit surprising that implied volatilities in the market for major currencies are quite cheap at the moment. Relatively cheap compared to the history. So maybe you should also think about using FX options to have more flexibility in your hedging over forward contracts. So this is a good opportunity for those who never made use of FX options, maybe to try it for your relevant business.
Yeah, that's excellent. A great point too about inquiring about being billed in the local currency to see if there's any potential savings. So next, how have sharp FX moves impacted customers you speak with? Moves have been both large and very quick. In some cases, for example, if you look at Aussie-US, the Aussie dollar has fallen 7.5% over the last 2 months. And if you look over the same period, the euro versus the US is down more than 5%.
Yeah, as I mentioned before, so rapid changes in currency often catch customers unexpectedly and unprepared. So this is what we see. As said before, customers are always happy with the current level of currency, but then when the big move comes, especially if it's very quick, then many of them are unprepared and then start to think about what should I do now. So what we can recommend is setting up a treasury policy in quiet times that enables you to react quickly in hectic times. So be prepared when the hectic times start. And it's also important that the very stakeholders that companies have inside, being it the CFO, the finance director, the treasurer, whoever is in charge of the business, they should all be informed in advance, so that hedging, when it comes to the market situation, can be carried out quickly. By the way, your account manager or hedging manager can help you in setting up a hedging policy, which then allows you to act in the market when the possibility is there. We also recommend sometimes to work with orders, especially if you are searching for a special rate. Let's say you always wanted to have the 105 in euro dollar. Now the market is moving close to it, but we're not really there. You can work with orders that you leave in the market for 24 hours, and then the order gets executed even when you're sleeping. So we watch these orders 24 hours in the market. You can focus more on your underlying business, and we can watch the currency order. This is definitely an advantage if you access the markets around the clock. And sometimes even you may have the benefit that your order gets executed, and in the morning when you come back, the rate is back to the older levels again. So sometimes it gives you the opportunity to execute an FX deal at a rate that you have not seen in your home time zone. But as a side fact, once we see a rapid move in any currency pair, it always happens that the implied volatility, which I mentioned before, which is part of the pricing for options, this will then increase also sharply because the market reacts on what we have seen in the market. Therefore, I think it makes sense also to buy options in quiet market when the volatility is low, and then make use of the flexibility in hectic markets. That is also maybe a recommendation that works, especially if markets are moving as we see it right now. So, I mean, what can clients do? It makes definitely sense to think about your own FX budget rate. So which rate is good for you? What is the best rate you want to see? What is the worst case scenario? So what is the rate that should not be exceeded to protect your business? And as said, I think you should speak to internal stakeholder, make your mind, and then work on these levels that you have defined for your relevant business. Whether then you use FX forwards or transaction with more an optional character depends on the underlying scenario. We are happy to speak to you, maybe help you with your individual answer, but it's entirely up to the underlying business.
All right, great stuff. Especially the part about the orders where you can really take advantage, say in the middle of the night when you're sleeping, given the 24 nature of the markets 6 days out of the week.
Mm-hmm. True.
Okay, so data says that credit conditions are tightening. What are you seeing? Are businesses starting to feel the pain of tighter credit conditions? Where getting loans tends to be tougher now?
That's absolutely true. This is exactly what we see in the market. So not only the interest rate moves up, but we also see that the credit margins are getting tougher for corporates. So it is an increased burden when you're financing your cash and you have to pay more money. Cash is not for free anymore. I mean, I work here in the Eurozone, and we have been used for free money over 8 years. So 8 years we had negative interest rates, and people were used that you can have as much money as you want, and it effectively for free. But that's over now. We see a widening of the credit conditions and a widening of the interest rate. That's why it's particularly important now that you should work cash flow efficient. I mean, so I think while customers previously simply purchase currency and access them over time, so let's say you bought some dollars, put them on your account, and you use them when you needed them, it's now more efficient to work with target currency forwards and only pay for the foreign currency when you really need it. So we would recommend that the cash flow planning should now be much more efficient than it used to be maybe in the last 8 years, at least here in the Eurozone, but maybe also in other currencies where the interest rate level was very low. So Maybe another additional point is the trading limits. What we sometimes hear from customer is that banks also try to minimize unnecessary trading limits in order to plan their own capital. So my advice would be secure your trading limits with your counterparts, with your FX brokers, and we are happy also to have that same conversation to you, so that when you need the market, when you see opportunities and you want to enter into forward contracts, that you have enough brokers available, so that the sum of your limits is exactly what you need for your underlying business. Please feel free to contact us, your account manager, your hedging manager in your relevant country, and speak to how much limit we can provide to you, and maybe what other banks provide you, so that you're secure to hedge your currency and the volumes as you need it.
Terrific. Thank you so much, Sven. Appreciate the insights.
Sure.
So now we want to move on to the Q&A portion. And I do see that we've already received a question here talking about the Mexican peso. Can you expand on your dollar Mexico forecast? Is there enough downside risk to require support at 117? Well, certainly the outlook for the peso, it's going to hinge on the Bank of Mexico. And it's really going to be who has to ease first. Does the Bank of Mexico have to cut interest rates ahead of the Fed? If they do, perhaps that's going to put renewed upward pressure on the dollar against the peso, and maybe we could see a move further above 17 per dollar. But again, right now, the peso is drawing really rock solid support, given those interest rate differentials. Again, more than 11% for the Mexican benchmark interest rates. That's double what the U.S. is offering right now. So we'll keep our eyes on U.S. economic data. If the U.S. economy continues to show signs of running a bit hot, and if inflation if inflation only moves gradually back down to the Fed's 2% goal, well, then maybe there's another rate hike on the table for the Fed. And when we hear from the Fed a couple weeks from now, like I said, on the 20th of September, we're going to get some new economic forecasts. So they'll come out and say where they see interest rates ending this year. Is it status quo around 5.4%, or is there another quarter point rate hike on the table? It seems like the Fed is reluctant to abandon its tightening bias anytime soon, because it really hasn't gained sufficient confidence that inflation is headed towards its 2% goal in a sustainable fashion. So that's one thing we can look out for, and hopefully that provides some support at 117 for the peso against the dollar. We had another question come through here. How many rate cuts do you see on the Fed's table for next year? Yeah, that's a good question. Well, the market view right now suggests that we could see as nearly 100 basis points in rate cuts from the Fed next year. And that's on the premise that if inflation in the U.S. continues to come down, it's just above 3% now, so it's not too far away. But the feeling is that the road from 3% down to 2% could be fairly longer and winding. And if that's the case, maybe we need to see another we need to see another rate hike from the Fed, or at the very least, what that can do if inflation doesn't move down in a timely fashion, maybe that can postpone when the Fed actually moves to ease policy. But if inflation's still coming down and the Fed holds interest rates high, at some point, the Fed runs the risk of keeping interest rates too restrictive, applying the economic brakes too hard, that it could really damage the economy. So if inflation continues to drop, well, then maybe that can offer some leeway for the Fed to ease policy. And that's going to be the key thing to look out for. But like I said, roughly around 100 basis points in rate cuts, the markets are pricing in. But that might seem overly optimistic, given what we're seeing right now with the U.S. economy faring so resiliently. There's another one. George, I'll pose this one to you. Do you see more downside risk for the euro in the short term, or is sterling euro set to peak?
Cheers, Joe. Yeah, good question. Obviously, we've seen the euro deteriorate over the past few months, and that's been related to the macro deterioration that we've seen, particularly from the German economy. Of course, the soft economic data points, the leading indicators appear to have found the bottom, but we are seeing those hard data points like retail sales, industrial production start to come through pretty negatively. So we have seen that weigh on the value of the euro. But have we seen that bottom in terms of negative sentiment of the Eurozone? Is there hope for a recovery of the euro over the kind of short term? Well, it remains to be seen, of course, but if we look at seasonal trends, something that we like to do is look at how not just currencies perform, but how the macro environment has fared historically. And the City Surprise Index historically has shown that in the second half of the year, the Eurozone, European countries tend to outperform. So the City Surprise Index being any downside or upside surprises to the economic data, and we often see more upside surprises in the second half of the year. So, if history is anything to go off, then perhaps we'll see a recovery of some sort, or at least a slowing of the weakness of the Eurozone, and that could help prop up the euro. But also the seasonality study in terms of FX this month, September, is often a positive month for the euro. So since its inception in the early 1990s, the euro dollar exchange rate has risen on average 0.5% in the month of September, and sterling euro has actually fallen 0.75% in the month of September. So it's something to bear in mind as well. But in terms of sterling euro, particularly as was mentioned in the question, I think as it currently stands, because the Bank of England is expected to continue hiking higher than the ECB, and because of the weak macro outlook, or the weaker macro outlook, we've got those yield differentials and growth differentials favouring sterling right now. But there is a larger vulnerability for sterling to be sold off because of this particular pricing, especially in terms of the interest rate outlook. And we've already seen a pullback from above the 117 against the euro for sterling euro there, back down to 116. But still, as I mentioned in the presentation, currently sterling euro is over 1% above its 5-year average rate of 115. So still current levels could be seen as attractive if you were a UK importer needing to buy euros. And something to bear in mind as well is that since the Brexit vote in 2016, sterling euro exchange rate has actually been below 115 for 60% of the time. So again, just signaling that the current conditions might be favourable to sort of hedge any euro exposure for the future.
Good stuff. And while we're on it, Mike Woodhead has a good question along the same lines here, or similar lines. Do you view sterling, euro, the rate being volatile in the medium future, or do you see the two closely linked in all senses?
Yeah, I mean, it's a good point. As I mentioned, the volatility in this currency pair is often very subdued due to the similarities between the currencies with their relation to the US dollar. If you overlay euro dollar and sterling euro, then they often track each other quite nicely. But I think that the actual volatility that we witness remains relatively subdued, just due to the fact that the economic outlook in both the Eurozone and the UK tends to be pretty similar. And in terms of the future, we don't anticipate a huge amount of volatility unless some key levels are broken. As I mentioned, that 115 level marks as a kind of pivot point for this currency pair. A break below that could indicate some more selling opportunities of the pound, driving the currency pair lower. But realistically, we anticipate quite a narrow trading range between the sort of 115 to 117 mark, unless something drastic happens. So, as I mentioned, the ECB meeting this month is the one that we're watching. Markets currently pricing 50-50 chance really of the ECB hiking. If they do decide to hike and they come out more hawkish, then this could inject some more volatility because it catches investors off guard. So that could be a reason to see some more volatility in the currency pair.
Yeah, absolutely, because already half the market is betting on the outcome going the other way. So that really sets the scene for some volatility. Well, it looks like that's going to conclude the Q&A session. I'll just have a few closing remarks here. Firstly, the email address that you provided to register for today's email will automatically send you a recording of today's webinar within 24 hours. You'll get that from Currency Convo, so please be on the lookout for that. You can also subscribe to receive the content. We've put that in the chat function, or you can speak with your account manager at Convera. And secondly, feel free to complete some of the surveys. The exit survey, that'll provide some feedback for us. Any recommendations of what you'd like to hear us cover in the future, that'll be important. And just a reminder that the webinars, we do these on a monthly basis, and we hope you'll come back in early October when we have our next one planned. And I want to thank the panel for joining me today. It's been my pleasure. It's been our pleasure. And I want to thank you guys for joining us today. So thank you very much, and we wish you all the best.
Have a good day.